Welcome back to Derivatives and Risk Education. In the previous lesson in the Derivatives Foundations course, number 14, we dove deep into forward rate agreements. Today, in lesson 15, we're going to explore another widely used instrument for managing interest rate risk, interest rate futures. Before we dive into the specifics of interest rate futures, let's quickly set the stage by remembering what we've already covered regarding futures in previous lessons. If any of these topics are new to you or you just need a refresher, make sure to check out the relevant lessons in this Derivatives Foundations course. First, in Lesson 1, Forwards, Futures and Options, we introduced the very concept of futures contracts as one of the fundamental types of derivatives. Then, in Lesson 2, Hedging, Speculation and Arbitrage, we laid out the core motivations for using any derivative product, whether you're looking to reduce risk, profit from market movements, or exploit mispricings. For the detailed mechanics of how futures contracts actually work, you'll want to revisit Lesson 3, Futures Markets Part 1. That's where we explored how futures contracts are created, their standardized features, and the crucial margining system, complete with practical examples of how it all functions. Finally, in Lesson 4, Futures Markets Part 2, we discussed the different types of traders operating in the futures market and how futures contract prices are generally quoted. Today, we're building directly on that foundation. We're going to take all that general knowledge about futures and apply it specifically to the world of interest rates. So, what are interest rate futures? Well, they are futures, so they have all the features that all futures have. They are exchange traded, standardized, and hence highly liquid. They are interest rate futures, so they have some kind of interest rate or interest rate product as their underlying. Interest rate futures broadly fall into two main categories: those based on short-term interest rates, often called STIR futures, and those based on longer-term government bonds. STIR futures allow you to hedge or speculate on short-term interest rates, typically those with a 3-month tenor. Historically, the most common example was the Euro-dollar future, which was based on the 3-month US dollar LIBOR rate. However, as we discussed in detail in Lesson 9, the risk-free rate, LIBOR has largely ceased to be published, and the market has transitioned to risk-free rates, or RFRs. Today, key RFR-based STIR futures include SOFR futures, which are based on a 3-month secured overnight financing rate, SOFR, for US dollars, and for British pounds, we have SONIA futures, based on a 3-month sterling overnight index average, SONIA. Now it's interesting to note that in the Eurozone, while new RFR-based derivatives like ESTA futures have emerged, Euribor rates are still published, and reformed Euribor futures are actively traded. Euribor now uses a hybrid methodology that incorporates actual transaction data, making it a robust benchmark that continues to be a key tool in the Eurozone multi-rate environment. A crucial aspect of STIR futures is their unique quoting convention, often called the index price. They are quoted as 100 minus the annualized interest rate. This quoting method is deliberately chosen to align the price-to-rate relationship with what you see in the bond market. Just as bond prices increase when yields fall, the STIR futures price increases when the underlying interest rate declines. At expiration, STIR futures are cash settled, meaning there's no physical delivery of any underlying instrument. Moving to the longer end of the curve, government bond futures allow you to hedge or speculate on longer-term interest rates or bond yields. These contracts are based on notional government bonds. You'll find futures on various government bonds from different countries. Examples include US Treasury futures, such as 2-year, 5-year, 10-year Treasury notes, or 30-year Treasury bonds. There are Bunds futures from Germany, Gilt futures from the UK, and Japanese government bond JGB futures. Each contract specifies a hypothetical or notional bond with certain characteristics, like a 10-year bond with a 6% coupon. Government bond futures are quoted in price terms, much like physical bonds themselves, directly reflecting the yields of the underlying bonds. The settlement for government bond futures is a bit more complex. These typically involve physical delivery of an eligible government bond. However, there isn't just one bond you can deliver. A range of different actual government bonds might be eligible for delivery. To account for differences in coupon and maturity between these eligible bonds and the notional bond specified in the contract, conversion factors are used. These factors adjust the invoice price to make all deliverable bonds financially equivalent at a specific yield. This brings us to a very important concept, the cheapest to deliver or CTD bond. The party obligated to deliver the bond will always choose the bond from the eligible list that provides the lowest cost to them after accounting for these conversion factors. Essentially, the CTD bond becomes the effective underlying asset of the future, as its price movements will largely drive the future price. So, how are interest rate futures used in the real world? Their applications broadly fall under hedging and speculation, which we discussed in lesson 2. For hedging, they're indispensable. For example, a pension fund managing a large portfolio of fixed income assets might be concerned about the rising interest rates reducing their future returns. They could sell government bond futures to protect against such a decline, using the futures profits to offset losses on their existing bond portfolio. Speculation is also a major use. Traders who take a view on the future direction of interest rates can use futures to profit from those views. If you expect rates to rise, you would sell or short interest rate futures. If rates indeed climb, the futures price falls. Remember that inverse relationship, and you'll profit from your short position. If you expect rates to fall, you would buy or go long interest rate futures. If rates decline, the futures price rises and you'll profit. Let's quickly walk through a simple numerical example with a STIR future to see the profits and loss mechanics in action. Suppose a fund manager believes 3 months SOFR rates will fall from 5% to 4.8% in the next 3 months. They decide to buy or go long one 3-month SOFR futures contract. At 5%, the futures price is 95, 100 minus 5. If the rate indeed falls to 4.8, the new futures price would be 95.2. The price increased by 0.2 or 20 basis points. Let's say 1 basis point move is worth $25 per contract for these futures, which is normally the case. Since each basis point is worth $25, the profit on this long position is 20 basis points times $25 per basis point, so $500. This simple example shows how changes in the underlying interest rate directly translate into profits or losses on the futures contract, making them effective tools for hedging and speculation. To wrap up, interest rate futures are highly liquid, standardized and exchange-traded instruments that are absolutely essential for managing interest rate exposure in global financial markets. We covered the 2 main types, short-term interest rate futures like SOFR and SONIA, and longer-term government bond futures with their unique delivery mechanisms and their practical applications in hedging and speculation. Thank you so much for joining me today. If you found this lesson helpful, please give it a like and consider subscribing to Derivatives and Risk Education. Thanks for watching, and I'll see you in the next video.